Welcome, everybody, to another edition of ATLalts. This is your host, Andres Sandate. I'm excited to have two guests on with me today from Mount North Capital. I'd like to welcome Brian Seidensticker and Kiah Hochstetler, co-founders of Mount North Capital, which is an opportunistic real estate investment platform, to the show. So thank you for joining me, Brian and Kai, and love to welcome you to the conversation. ATLalts, as you guys know, is a alternative investment show focused in the private markets, and we interview experts across the industry. So our audience is financial advisors, it's independent wealth managers, family offices, high net worth individuals who are really looking for education and opportunities to learn more. So we appreciate you joining us today. So with that, Brian and Kai, welcome to the show.
Well, thanks, Andres. Thanks for having us.
Yeah, I'll jump in right away, Brian, and start with you. I'd love for you to give us a little bit of background, maybe about Mount North Capital. I mentioned it's an opportunistic real estate firm, but tell us a little bit about yourself, and then we'll have Kai go next.
Yeah, well, my background is actually as an aerospace engineer. That's what I was as a trained profession anyway, and did that for the first 12 years of my professional career, and then for various reasons ended up in the delinquent tax sale space, providing data software, and that's actually how Kai and I met, is on that side, and then joined forces. And one of the leading complaints, if you will, or pain points for our customers was basically a funding source for tax sale properties in general, and we went down a route of trying to get a bank on board that didn't work out, and we'd done all this work and kind of looked at each other and said, hey, maybe we can start a fund to do this. And that's essentially how Mount North Capital was born. It's evolved a lot since then, but that's a little, I guess, the quick version of an origin story.
Yeah, well, thanks. We'll dive into that. Kai, I'd love to get a little bit about your background too.
Yeah, so I had the pleasure of meeting Brian through an IT consultancy that I had founded and started providing services to tax sale resources. As time went on, saw the opportunity to take some of my experience in the software world and move it into developing an asset management platform for tax lien investors. Over time, Brian and I decided to join forces and bring our companies together. During that period as well, I was doing investment work for a family office that has grown. And as we started talking about the capital allocation side and my experience in the world of private investment and funds, it made sense to transition into the next chapter of tax sale resources and SDA, which we launched Mount North Capital off of.
That's great. I know there's a lot of things we want to dive into today for our audience. Again, sort of framing this up for people, when we're thinking about bringing a guest on and diving into an asset class, let's talk about real estate. You obviously have a lot of different areas you can go. And so for us at ATLalts, it's really fascinating to meet experts and sponsors and investment professionals who are doing what I think are highly specialized, niche, and sometimes more esoteric real estate, in this case, strategies. And so you've mentioned tax liens, and so can we maybe high level talk about this asset class that you're in within real estate? Either one of you are welcome to maybe tackle that, but just to help the listeners understand, when you guys say tax liens and the real estate that your guys' investment specialty is within, what does that contain?
Yeah, I guess the fund as a whole is what we do is pretty basic, right? Buy real estate at a low price, sell it at a higher price. There's nothing nothing fancy about that. I think the magic comes in of like how and where we're finding these particular properties. And though we're not isolated to tax sale properties, that certainly is how we got started, and still a lot of the way we acquire the properties. And really that type of property, comes around or comes through due to a tax delinquency, right? We don't do a lot in the tax lien. I like to say, there's really three buckets of like tax sale types, right? There's tax liens, tax deeds, and then there's like a middle ground that we like to call redeemable deeds. And the fund itself focuses much more on the the redeemable deeds and the deeds, the real estate end of it. The tax liens is much more of a micro mortgage, scenario and a note scenario, and we're in more of the real estate space.
Yeah. So you started a business. Well, you were running a business, Kai. It sounded like, and we're working with Brian. You give us a little bit of background. We want to learn about the asset management part of this this business, but I think it'd be helpful for listeners to kind of understand all the different moving parts in the platform, and then maybe how the two of you came together.
So within the tax real estate industry, right, when you start dealing with these distressed assets and assets where there's unpaid taxes on them, on the tax lien component, which is where both Brian and I started, Tax Sale Resources was aggregating data. In total, they have over 3,500 scrapers that they built over the years, and a substantially proprietary data system to work off of. And as we moved through that process, as Brian's company was providing the underwriting data, then it moved into an asset that was acquired by an investor, whether it was a small scale retail investor moving into more institutional hedge funds. And as you can only manage so much on a spreadsheet, and as that grew, we started building this platform around that to support funds that had tens of thousands of assets on the tax lien side. But then they would roll into additionally the tax deed component, or those tax liens would become REO. So organically over the years, the features and functionality of the platform grew to encompass the entire life cycle of the investment. And that's really where we saw the opportunity to build a fund at scale, is through both the proprietary data that we're able to pull in through it's publicly available, but it's not an easy effort to look at a national level of data set. And anyone can go down and get a tax list, but when you start, underwriting across multiple markets and states, it's a heavy lift, and that's something in the work that we had already done. And then as far as the asset management goes on the platform side, running, when you start dealing with, hundreds of assets, things will fall through the cracks. And so the system really supported building rule sets around making sure things didn't fall through the cracks. They were, reminders and to-dos based on the life cycle of an asset, providing bankroll reportings for lenders, and allowing access for tracking of the financial components as well, to understand the underlying profitability of a single investment, but then look at it in an aggregate fund level.
So when you set up Mount North Capital, and every asset manager that's out there in the alternative private market space is, many of them are trying to take advantage of inefficiencies and complexities and aspects of a private market that you just can't do in the public market. So when you think about opportunistic real estate, and as you said, Brian, getting to the real estate, where you're effectively, buying low, hopefully selling high, right? Very simple. There's a lot of things that go into that. So help us really understand sort of the maybe a summary or overall of the types of assets that you're out looking for. There's different ways that you're going to call it originating. There's different ways that you're identifying opportunities, and every manager goes about that process differently. You've clearly got a methodology and a lot of background and a platform that's informing a lot of your thinking and proprietary nature of it. But I'd love to understand how you're identifying the opportunities that fit for Mount North Capital.
Yeah, I think we were lucky to have this 10 to 15 year foundation of the data analytics software side to lean on, and what we're doing isn't real proprietary, right? It's how we're doing it, right? And it really comes down to we were already tracking when, where, and what properties were in these auctions, but then we also started gathering the results of those auctions, and we've dovetailed not only just the tax sale, but into trustee or mortgage foreclosure space as well. And so the unique part of it is just having all of those analytics to know, take advantage of the inefficiencies is what it comes down to. And those inefficiencies can be for different reasons. Some pretty straightforward with, live auctions in the middle of nowhere typically have less competition. And so, if you can see those and the assets make sense, and you make a, concerted effort to attend those, then typically you can do better than your average investor that's, sitting on their couch attending an auction online where everybody in the world can participate. And that's one example. And then there's, just various other analytics that we look at to try and identify, markets, and then ultimately trying to identify the specific properties to go after as well. Because the industry as a whole is as much about, deciding what the property might sell for as much as is it going to make it to sale, right? And so we have a lot of advantages in identifying the properties that are going to go to sale and at a price that makes sense for us.
Yeah, that's fascinating. One of the things I'd love to sort of, dive into is when, you sit down with a wealth advisor or a family office, and they look at funds and they evaluate alternative investments in private markets. And many of them are expressing more and more that they want to find investment opportunities for their clients, right? And in your case, a strategy that generates very, in this case, like more of an income play, more of an income versus a growth play. So you're trying to provide like yield or income to your underlying client as one of the objectives of the strategy. So when you dial it back to the wealth manager or the family office like person that's looking at the strategy and they're not familiar with your space, they're not familiar with, we're used to buying multifamily assets, we're used to underwriting like clean buildings. We can go on property, we can get like clean title, there's insurance, and so I know that a lot of aspects of what you're doing involve, as is value, potential value, like what's the unlock. So maybe Kai, you can tackle this one. You come at it, you've got a lot of software experience, you got a data background. Like, are we overthinking it? When we're the wealth manager, when we're the family office, or is there really a lot more to it that does provide, require like a professional asset manager that's got an edge, that's got a platform, that's got a team, versus the person, like you said, sitting at home on their couch, trying to do this. I'm curious.
Yeah, from the underwriting analysis and capital allocation perspective, at the end of the day, a lot of it comes down to portfolio theory. So right, when you approach underwriting, there's your standard checkbox that you go into. But given the state of the assets, given that we can't get inside of them, all of that goes into the underlying buy price and our willingness to pay. And so there's discounts applied at auction at that level. And if you don't apply portfolio theory where you're doing them in aggregate, like you will have assets from time to time that pop up and you have issues with and you have to work out. And not every one of them are winners, but you check the bulk of the boxes and make sure that it's addressed. And so by applying portfolio theory, for anyone who's ever looked at private, venture portfolio theory, some studies are, 50 companies that, to provide a reasonable return. Like the same concept applies. We're doing it at scale at, hundreds of properties at a time as we're moving through this to allow it to provide the yield and return that we're bringing to our investors and provide the economics and underlying support that makes sense for us to operate the fund. And there's risk in doing one-off. And if you can't get inside of it, there's risk in doing one-off. But by applying portfolio theory, you can mitigate that and provide the economic outcomes that everyone's looking for in an investment.
Yeah. Maybe let's dive in a little bit to, how you think about the, I guess I'd call it the mitigation aspects of it. So, you've clearly got like an advantage when it comes to analytics and data, right? But there's other elements to it, experience clearly. But maybe Brian, you can talk about when you go to assign value, right? When you go to actually make an offer on an asset or put a price to an asset, like maybe help us understand what that entails. Because in real estate, they always say, you make your money on the buy, right? You don't make your money on the sell. I mean, that's an old adage, but we're here to educate. We're here to help wealth advisors, families, individuals that are out there trying to find, the next really attractive opportunity to earn yield or growth, in this case, yield. So we want to help them understand like this manager is different because there's so much dispersion in returns when you look at private markets, right? So you could have a top decile manager doing the same exact thing in a different part of the country to a bottom decile manager. And if you get it wrong, your client and or your portfolio is going to suffer. So you really have to understand the manager and their background and what their edge is and how they go about pricing assets. So a long setup to like a question of when it comes to price, like help us understand your methodology and approach.
Yeah, I think most people are familiar with what I'll call as repaired value, because most houses and neighborhoods and commercial buildings you drive down are already in that state, right? They are in, yeah, you could put some money into it, but it is already repaired. You can get what we consider market value for that property. Now with the type of assets we deal with, that's rarely the case where the assets in that state, right? And so what we deal with in part of the hard part of our job is deriving the what we call the as is value, right? And there's two components to that as is value. One is a discount, really due to the whatever work is needed to bring that property back to an as repaired state, like the structure itself. And so, for sake of numbers, let's say it's a $200,000 house, right? But it needs $100,000 in work. We consider that $100,000 as is value, right? And so we deal with as is values. The other aspect of our industry is from a title perspective, right? Which is dealt with more on the tax sale side. But you have to account for things there because you typically don't get title insurance. And so you definitely need to know what you're doing in order to identify what stuff on the title needs to be dealt with, right? And what is that going to cost? And that's all part of our underwriting and ultimately our price, or strike price, right? Where we're going to buy it at. And then we say we're only going to buy it at 65% of that as is value or less, right? And so we do all of our work. We say, that same $200,000 property, we say it needs $100,000 worth of construction and title clearance work on it, right? And so the as is value of that is $100,000, and we will buy it for $65,000 or less, right? That's kind of the margin of safety and profit that we're working with when we identify, underwrite, and then what we're willing to bid it up to at those auctions.
Yeah. And maybe you can help us understand the actual execution of the acquisition itself, right? Because again, what we want to do here today, hopefully, is help people and inform them, right, around the idea that there are different managers and different strategies to go out and build exposure if you want exposure to real estate in your portfolio, right? And I think as alternatives continue to proliferate, one of the things we're going to keep doing at ATLalts and that we're doing at our wealth management firm is we're just continuing to pound the table to folks to say there are 5 or 6, well-known common alternative asset categories. But within those categories, in this case, real estate, there's debt, there's equity, there's there's core plus, there's value add, there's opportunistic within opportunity. You know what I mean? Like, so helping people as they're on that journey is really critical to, get the right subject matter expert to execute that particular strategy. So again, with that lens of sort of informing, maybe Kai, you can take this one. So when it comes to, okay, you've done your underwriting, you've identified an opportunity, you've done the underwriting, you've come up with the, the as is value. Walk us through some examples or scenarios, within the fund itself around what does the execution of this look like? Because you say auction, that's different than my notion of fee simple real estate where we've got exclusive, we're walking the building, we're walking the property, we've got site inspections, we've got access to the inside, all this history, all this, property condition report. I mean, that's different, right? So I think if I'm an investor, I want to understand, like, when you guys go to actually execute at auction or whatever the format is, what does that look like?
Well, depending on the size and right of the county, I mean, we put people on planes, every first of the month, and if there's other auctions throughout the month, and so we're doing our initial underwriting process where we're doing drive-by and getting photos of the current conditions for the underwriting, and we're sending bidders to these auctions with a clipboard to stand there. There's logistics involved in management around that. Of you have to come with money order with cashier's checks in hand, ready for the amounts that are there, and so there's a lot of procedural management of that side when you start talking about scaling up a fund and making sure that everything's in check. And they get there and they start bidding and they start going through the process, and they've got maximum bid prices that they move through. And one of the key components in that is sometimes we win everything we want, and other times those bidders come home empty handed, but we have to stick to our fundamentals of underwriting. And we can't look at this and say, okay, you have to come back with something, because the moment we start applying that pressure to our bidders, we're going to start making fundamental mistakes, and that's just not how we're going to run this fund. And within that process, sometimes there are 2, 3, 4 people at the county level or city level running an auction. And so our bidders are running around and looking, okay, what's property's up next over here? Which one is it at? And sometimes there's multiple bidders at a single auction. And so it turns into a bit of a rodeo from that perspective to try to come home with. And there's stories. Our bidders come back with stories all the time of, local investors and, who are trying to pay for everything with cash for a $300,000 house, and they got to run back to their car. They're unbelievable. It's just a wild process. And so in our institutional process, there's not really a lot of other people showing up at an institutional level. We're really dealing with local competition. We're underwriting against our data sets that we have. And so we're bringing in an additional level of, sophistication to that process. And we're maintaining our fundamentals so that we're not getting over our skis on something and we're getting too far into an asset and we don't have that room to address any unknown issues that are coming into it, and making sure that there's room to breathe in this. And you articulated earlier, right? You make money on your buy, not on your sell. And making sure that there's enough room in there to both cover our capital costs and to deal with the values that are there. And one of the pieces that we haven't dove into, and really, once an asset's acquired, in our underwriting process, it gets a grade. That grade, it's one of 4 categories. That grade is then reevaluated after acquisition for where it's at. And we're not going to take all these assets through a repair. We will selectively choose asset by asset. Is this one appropriate to wholesale to a local fixer and flipper? Is it appropriate, and is it in a condition where we can take it to the primary MLS market for either an owner-occupied or a landlord who wants to lease it out? Or is this something that we have a lot of margin opportunity, and this one makes sense to go through a construction process? And we're not getting into the process of, removing, full roof systems or moving walls around. We're talking about changing out the visuals, flooring, cabinets, some of the HVAC equipment, like getting into some of these things that are fairly quick turn and burn processes, applying paint, changing out doors and sometimes windows. And so it's not, we've all heard stories and we've all seen where people have lost investments when they've over repaired, and avoiding the over repair scenario is crucial. We're better off to make a small spread and move it to a fix and flipper than we are to try and go for the large win. And on that, if it's something that, it's a market where construction costs are higher. And so understanding what the construction industry is at that capacity in that market is also crucial as we get into it. Our model isn't dependent on us repairing these things, and it's just opportunities to garner additional return on the process.
Yeah, so many great points within that. Brian, you got your work cut out for you because Kai scored a bunch of points here on the ATLalts show with that answer. But it leads me to no, seriously, like questions around, okay, so you have, let's call it, use these analogies, boots on the ground, they're attending these auctions, they're your eyes and ears, they've got they've got a process that they're following, and price or values, strike price, that they're able to obviously they want to get the property cheaper if they can, but they've got sort of a ceiling. So Brian, come back to you here. So Kai, I think you laid out there are a series of different options that you have at your disposal after you if you win at the auction or successful at the auction. They don't always have to be complete like heavy rehab projects. So Brian, talk a little bit about like that on the front end. Do you have an idea of these properties? You mentioned people are traveling and looking at this, and it sounds like there's a lot of residential assets, but is this strategy limited to residential properties, or is that largely what you're seeing in this opportunistic real estate strategy?
It's definitely the majority, right? But it's not the only, right? When
Okay.
I say, single family, residential homes, it's really more of what is available and what is the opportunity.
Yeah.
We truly are an opportunistic fund in the fact that, we take advantage of value add when and where it's applicable.
Yeah.
But our primary model is, acquire the property and disposition that property as quick as we can, right? Making a decent return and then recycle that, right? We feel that there's a whole lot more volume that we could go after. So there's no reason to hold on to a property, for longer than we absolutely have to. The type of properties that we're going after really comes down to the partner, the profit partner that we're working with, which is usually somebody there locally, right? Which is part of our process is, coming from tax sale resources and the services that we provide, and the, how we came up with the fund concept in general was to enable these local investors that are historically very, cash strapped, right?
Yeah. Constrained.
Tax sale, just any auction model is very cash intensive because you have to have hundreds of thousands, millions of dollars really to make it a full-time thing. Otherwise, you're always buying a property or two or three, right? You're doing whatever you need
can't drive around in a vehicle with hundreds of thousands of dollars in your car. I mean, and so it just is not a scalable model. So I completely appreciate what you're solving for. But you allowed me to ask a follow-up, and so I really think people are going to benefit from understanding the pieces of this platform more so than just the siloed parts. So if I understand it, you have a data advantage, call it, because of the analytics and because of the proprietary data sets and the models and all the things you offer in the marketplace through tax sale resources. But you also, through that, now have access to boots on the ground and expertise and local investors that say, hey, man, if it weren't for being constrained, I could go do those 3 properties because I know this area, and I know there's opportunity. Is that right? Am I getting that piece right?
You're exactly right. I mean, the partners we're working with locally, who are boots on the ground, that they already typically know exactly what they're doing. They've been doing it. They're just cash limited, and so our whole strategy is identify those folks, build a relationship, and then enable them to do what they've already been doing, just on a little larger scale. And so they don't have to buy 3 properties, do what they do, and then wait for them to sell, open up that cash, go do it again. They can just keep doing that process over and over. And that is, certainly a piece of our model, right? Which is very unique in that we're not trying to organize all this with a gigantic internal team, all located in one office, right? It's very heavily focused on the local boots on the ground and the partners that we work with to identify the properties, right? And then we work with them to identify what we feel is value, right? We purchase the property. We always own the property, right, throughout the whole process. And so, we are collateralized, entirely by the owning of the assets. As we're not doing notes or loans or anything like that. And so it just ends up being a really good relationship where the asset class we're in, how we're acquiring them, right, allows us to make a good return, but then still has enough left over for that profit share partner to benefit as well.
Yeah, you have to leave something for them, right? Because you want them to be motivated, I would imagine, to complete the project quickly, on budget, right, and get it back to market per the asset management plan. Is that right, Kai?
Yeah, and well, before we jump to that piece, like there's one component there that I want to articulate that Brian mentioned, and just is it right, our process, like other funds that are in this space, right? Some of the hard money lenders, things like that, they have a note against the property. We own and control the property the entire way through with these partners.
Yeah, that's a big difference. Yeah, that's a big difference.
If something ever goes sideways, because you have to plan for when things don't go perfect. And if anything ever does go sideways, all we do is, execute the legal notice saying you're failing at, the piece that you committed to, and we step in and start managing the asset. And so that there's no need to go through any sort of legal process around that because the asset is deeded to the fund. And that provides we'll call it belt and suspenders, so that we can not get stuck in a legal process and not get stuck fighting it out and dealing with extra legal expense. It's just, you're not doing your part. We're going to step in and take this and go with it. And so in that asset management process, it allows us to scale between both having kind of the redundancy of some internal teams that do this, but also the scalability of the boots on the ground partners in markets that is a unique model that is working really successfully for us. And, we have to underwrite them. They have to bring track record to the table, or else that's where you get upside down in a fund. And the key component there is making sure that you're not scaling too fast but scaling at an appropriate rate. And because you don't want to buy yourself headaches, and we've all either been there or seen people do it. And that's what we're trying, and that's what we're managing against and managing for, is that it runs smoothly in this process of working with on-the-ground partners.
Yeah, this partnership model I think is really interesting, because you're underwriting the properties, or in this case the asset, but you're also underwriting the operator, if you will, on the ground. And other lending programs are doing something similar in a way. They're underwriting, the if you will, the borrower if it's a hard money loan. But what's different is, they've got to kind of understand what they're doing with the asset. But it seems that you guys have a distinct advantage in that you can step in without all the judicial process and all the the legal expense and the hassle and just give me more time, right? You just say no, we're stepping in and taking over. So I hope that our listeners will make the effort to really understand that. But I want to give you guys the opportunity to really draw distinction. So we've done some shows around private credit, direct lending, private debt, because it's an area where there's a lot of interest, right? People are looking for different ways to get yield in their portfolios. They're turning to their wealth advisors. The families are looking for non-correlated, non-bank lending strategies. So I want to give you guys the opportunity to make crystal clear to folks, like, how are there other elements beyond, you guys in the hard money and the bridge lending space? Are there other aspects of what you're doing that are distinct, that that listeners should understand, that insulate the investor, or provide more protection? And Brian or Kai, I'll let either of you maybe address that question.
Kai, do you want to take initial shot at it?
Sure. So as we've talked through the process, right, differentiation is, we're aggregating our own data sets. That's core point number one. And then it moves on to really the asset management platform and industry understanding, especially when it comes to the tax deed side. And state by state, we have different criteria, different things that we're managing for in our legal underwriting process. And that changes, and you managing the relationships with the attorneys when we do have to do the legal work, and knowing who can handle that at scale and move them through the process so they're not getting stuck with that. And you have assets that are just sitting there on the books and underperforming because of extended process time. And then you layer on the ability to scale with these boots on the ground partners that provide the scalability into different markets, which creates, as we're moving between states and markets, it's also creating diversity. And so you're reducing your exposure. While you're in the same asset class, you're reducing your exposure market by market by having it within different partners, as well as our internal team managing those. And so that you're not getting overweighted in a single market where, if a manufacturing plant pulls out, or whatever list of things go wrong in markets that start to cause, a reduction in asset price. And so you're not overexposed there. And then as you move to the next level, it's really the marketing list that we've built over the years, right? With over 60,000 people on our newsletter. While they're not all people who are interested in the hard assets, but having those relationships because of the over a decade in the industry for where we wholesale these products, and knowing how to move the assets off of our books and into somebody else who's going to take them to the next level if we're not taking it through the repair process into the primary MLS. And so what it does is there's no silver bullet, right? You start building the layers, you start building the strategic advantage. And that's what makes this thing durable and interesting and a worthwhile, investment to be in, is because it's layered. When you go out there and you see somebody who's like, we have this one thing and this is our market differentiator, and it's this, that's not a very good moat. And you start building a moat around just process and time in industry and ability to move through it and work. And that's what's kind of our fund differentiation. Is we didn't start out to be a fund. We started out to be a service provider, but the organic nature of the resources that we had led us to the point where it said, well, the smart next move is really take all of these things and make a fund out of it.
Yeah. Well, and there's a lot that goes into that. But Brian, it sounds like you want to make a point, or
Yeah, well, I think there's three really key things that make us unique, right? And then maybe there might be others out there that compare, but I'm not aware of them. But one of them is that we are 100% asset backed, right?
Yeah.
Or extremely heavily asset backed, right? We're not lending. We're not a lender. Everything that we purchase is owned by the fund. And so in a worst case scenario, you're not trying to collect on a piece of paper through a legal process, right? There's something very unique about that. I think the other one is the fact, we in general aren't looking to own these properties, ideally less than a year, typically less than a year. We can go longer than that, but when you do the long-term strategy, right, there's a lot that you don't know what's going to happen 2, 3, 4, 5 years down the road. And so there's a lot of, I'd say, potential risk of that where we're trying to get in and out of assets. And so we have the ability to change location, change buy strategy, change sell strategy. We're not tied to, hey, we're in this, we gotta wait it out. Those are two pretty key components. I think the other one is, especially with today's atmosphere, is the coming from the tax sale space. Tax sales are counter-cyclical to most real estate. And what I mean by that is in recessions, typically you get a lot better deals at the type of auctions that we're going to, and the inventory goes up, which puts us at an odd advantage compared to most, just because of the asset class that we deal in. And those are two. I say three, sorry, pretty unique. You put those three together, it's a pretty powerful thing.
Yeah, for sure. I mean, and absolutely, this conversation, we'll also share it with our audience for Asset Back, which is kind of our sister podcast. The reason, I think it makes a lot of sense. Not only did you say the term, right, you teed it up, but most importantly is I think it's helpful for investors, and their advisors, to really understand when you're going to go into debt or lending like strategies, right? If you're giving capital to a sponsor or an asset manager and expecting yield or income on the back, on the return, you really have to underwrite the manager's ability to underwrite, and you have to underwrite their ability to own well collateralized assets, right, at hopefully like very attractive LTVs or loan to values. You want to get that asset coverage, right? So if something goes wrong, right, you're insulated. But what you just articulated is different than what a lot of private debt bridge lender type sponsors are out there doing. So I think it's worth spending time. So I appreciate you guys articulating that. I want to understand a little bit around the liquidity, right? So in private markets, the knock is always, I can't press a button and sell, right? And what I think advisors and I think family offices, astute ones, have known this for decades because their allocations reflect it. They've been allocating to private markets in the 30, 40, 50, 60, 70% for decades, right? And individuals are 1 to 2 or 3%, right? So there's a lot of, I don't want to say catch up, but there's just a lot of opportunity to educate advisors and individuals directly around the merits of a diversified portfolio. Having said that, one of the first things that you run into is people's fears and misunderstanding about liquidity. And so I want to talk about what you said, which is a lot of times people associate private markets with these long-term lockups, 7 years, 10 years, 12 years, right? You're never getting your money back, for a decade. You just said it's 1 to 2 years, maybe, in many cases, ideally less than a year. And a skeptic would say that's not possible. Like, you can't buy real estate and flip it in a year, right? Or I just don't know that you could do that at scale. So I want to allow you, Kai, to talk about the way you've set up the fund and the profile of these underlying assets and why you're able to counter that and come back and say, no, actually, when an investor comes into our fund, this is the expectation, right? Or this is the expectation they should have around liquidity.
Yeah. Well, for the accountants listening, I mean, as far as our books go, right, we hold these assets, these real property assets, as inventory on our books. Right. We looked for ways to take advantage of, depreciation off of these things and some of the tax strategy around that. But at the end of the day, we have to hold it as inventory because we're moving through them at such a high velocity. And I think that's the truest sense of really like, how are we able to do that? It's buying low, selling higher, but still below, we're at wholesale market values for the majority of the assets that aren't going to the, owner occupied market. And with that, right, it's because we're focused on the opportunity for the next person, making sure that in our underwriting strategy, there's enough meat there for the next person to take it and do something with it, and they're motivated. And the model's, really supports that. It's dependent on that. It makes sense to do that. As Brian was saying, we can move through markets and we can move assets, right? We're always marking to market because we're buying the next asset. And at an auction, the highest price takes it, but it means that there's nobody else willing to take a higher price. You're not going in the private market deals where you're buying something, you're going in and saying, okay, here's my buy price, but it's not a true sense of like, what is the market willingness to pay at this point in time? And so an auction creates that, check and balance effect for really where the asset is at. And then with that, in terms of the investment terms, we have a 2-year promissory note that we offer our investors. It's we're moving the assets on a quicker time period, but the investment note is at the fund level. It's a 2-year term, and then they have the option to renew. And what facilitates and allows us to make sure that when an investor chooses not to continue on, that, right, because we're turning assets so fast and moving through that process of selling our inventory, we have available cash to take them out if they're interested in not continuing on with us.
Got it.
And so the model itself, all the pieces around this investment fund model work together so that we can deliver on our promises to our investors, and that we're not stuck. We're not saying, okay, hey, we're dragging this out another period of time, and now we got to do a capital call, right? These are not things that are built into this fund because of how we've structured the deal and the underlying business principles.
And the exposure that the underlying investors in the fund get is diversified across all of the fund's holdings. It's not just to one individual asset. So if they invest into the fund, they're not getting, the 3 latest deals you did. They're getting all of the holdings of the underlying fund that are deeded to the fund. Right, Brian?
Correct. Yeah. It's across everything, right? Which is, look from a liquidity standpoint, it's unique in the fact that, it's not as liquid as a stock that you can go sell now.
Yeah.
Right. But from an asset backed, it's very unique because typically those asset backed is all right. Yeah. It's a 5-year model, right? But that model turns into 7 years and then 8 years, right? And then you happen to have a recession in the middle of that, and then it turns into an 8 to 10 year, turnaround, versus, when you're constantly selling assets and buying new ones, then that creates that liquidity event at the sale of that property, right? And can we go sell every property tomorrow and liquidate the fund? It's not that simple, right?
Sure.
But it creates that constant liquidity and that constant growth and pattern, which is gives us a lot of flexibility.
Yeah, I know we're deep into the weeds, so we might as well keep going. We've got a few more minutes, but I think this will be very valuable for people that are really interested in learning about the strategy. And I think it's worth diving in on a couple of other important distinctions. And one of them is the market appetite. You've talked about this, Kai, and you mentioned this, Brian. Like, you have knowledge of these markets, and I know you're not investing, I would imagine, in every state. You've got some target markets that you're focused on for different reasons. I'd love for you to talk about that. But what I'd love to really dive into is this notion of like validated appetite in the market, because you have the knowledge, you have the data, you have the history, but you also have local operators that have expressed intent and interest in that asset. They just don't have the capital. They don't have the wherewithal. So you have this built-in, it seems like, distribution like system, right, for the asset in a way. Like, you've already almost solved for the exit. I don't want to put the cart before the horse, but I'd love to understand how those two dynamics, really help, right, your model work. Because you said, Kai, all these pieces kind of work together, and you're dependent on, right, that buyer, but you got to leave some juice in the deal for them. So maybe Brian could talk about how does that construct work? Like the validation of the appetite is there, but the distribution or the exit is already sort of built in inherently. Help us understand that.
Yeah, well, I think especially with the tax sale piece, right? A unique thing with those is the title itself, right? Is when you're buying it at the auction, you don't get title insurance from the county. I wish that were the case, but you never get that, and so you can't go get standard bank financing. And so a lot of the partners that we work with, they are the liquidity event, because we help them. I think of it as kind of bridge financing scenario. We help them on the acquisition, help them once they get standard financing, and then they're the ones taking that off our hands. We make what we're supposed to make. There's still enough left over for them to do what they need to. And that doesn't happen in every case, but that built-in buyer from the very beginning is a unique thing that typically you don't have. Now, in all cases, right, is we're trying to buy at an extremely conservative value that leaves enough in there for some other person that's looking for a discount, right? We're buying it at such a good discount that we can sell it at still a good discount that somebody else can take it through the value add, scenario. And that being a strategy from day one, right, allows us to disposition properties a little faster than typical.
Yeah. So Kai, I want to give you a chance to talk about, if we zoom out of some of the nuances. But I said I had two questions, so I'm going to hit you with this one. Talk about the this idea of being in the first loss position, like, and how you further insulate investors. We're coming into your fund, right? So we really like the space. You guys are opportunistic. You're finding all these opportunities, but you're doing even more, right? So like, talk a little bit about how you guys have set this up and structured it, and explain first loss to our listeners, because I think when people hear loss and investing, it's like, keep me away. These guys are doing debt and first loss, like, so maybe unpack it for us.
Yeah. So really the first component, and we talked about earlier how Brian and I started our business journey separate, providing me providing services to his company, and in 2020 we brought our companies together under Last Best Partners, which acts as a holding company for the operating entities in the data and software space. And as we move forward, we launched Mount North Capital, which is held underneath Last Best Partners. And so with that, the promissory note that's signed at the fund level also comes with a corporate guarantee from the holding company level. And so we provide that first loss position that's really encompassing all of the operations within this sphere and within this ecosystem. And so we're saying, okay, we're putting all of our businesses on the line. We're saying that we're going to deliver that return to you as the investor. The other component, right, and I know people are sitting there wondering, when they start thinking debt, you start hearing position. So you've got your first, second, third position debt. The way that we've addressed that is there's an intercreditor agreement that every investor signs. And so at the end of the day, it puts everyone on the same plane. And so it acts more like equity in that sense. And so everybody sits at the same level. So you're not dealing with positioning. And so your first hit is that, corporate guarantee that we provide. And then everybody sits at the same plane as, for all the lenders that come in as the investors. Mm-hmm. And one of the other components, which is in the weeds, but we looked at equity for this. And some of the challenges with equity was there's no efficiency coming off of the assets. So there's going to be, phantom income because you're not getting any depreciation because it's held as inventory. We're in, 12 states, and that number is going to continue to grow. So you're getting K1s coming out of all these different states. And at the end of the day, for the simplicity for the investor, we said, let's put this in a wrapper as a promissory note, throw an intercreditor agreement around it, and put a corporate guarantee there. And that's the cleanest way. It's a yielding asset with quarterly payments and a 2-year term.
Got it. Well, I think, I think it would be helpful for people to understand, and listeners to understand, this notion of like returns get competed away a lot of times in efficient capital markets when there's money to be made, right? Let's just call it what it is. Like the moment people start realizing, oh, we can make money, it's like everybody goes, bug to the light type of thing. So, Brian, maybe you could talk about how big this space is annually, or the size of a vehicle you guys, believe you could manage, given this opportunity. Number one, it's like scale, but two is talk about why that hasn't happened, right? Why have more asset managers that have gone into every other, great asset class, like where they can make returns, like why are you not seeing more of them? So just like scale, and then, competition.
Yeah. So, scale side, it's grown immensely, but I'll kind of, when we first put the fund together, we were focused very much on the tax sale side. And one of the unique things that Tax Sale Resources did, several years ago is do the first like industry-wide analysis of how big is this space. Nobody really knew. And when we did that, we went, wow, from on the tax lien side is about $4 billion a year. On the tax deed side is $4 to $5 billion a year. Wow, this is a space that is larger than most people know about the NBA. It's a larger space than the NBA. Now, does every asset meet what we are looking for? No, right? And so we did a very in-depth analysis of like, okay, out of all of that, what would we actually be interested in looking at and buying, from a data perspective? And we feel on an annual basis, there's $100 to $200 million in tax deeds that we feel would meet our metric, right? So there's a significant amount of growth from where we're at today, which we're at 30-ish million at the moment.
Yeah.
Now and so on the why aren't there more people in this space doing it, right? I think one of the hardest things, which is we're, to my knowledge, the only ones that have it, is just knowing where to go, what to buy, and at what price. And we're the only ones that are aggregating that information on a nationwide basis like we are, which gives us a large, competitive advantage.
Sure.
And then also having the flow of partners, right, that we work with, as well as the asset management component of it, which we built for institutional folks that we could grab on. I think the asset management, that's not the only solution out there, but when you put all of that stuff together, it's a very hard space that historically you haven't seen institutional funds doing it like we're doing it. I think there are some institutional folks that have focused on very specific areas, because if you're going to do it all, I'll say in-house, right, with your own team, you really got to know the markets you're in, right? Because you can't rely on that local profit share partner. So to some degree, we're letting out a little bit of our secret sauce of how we're doing this, but you put all that stuff together, it is very, very hard to put all those pieces of the puzzle together. And quite frankly, Kiah and I, when we got started, we didn't put this puzzle together intentionally. It really was we started on the data analytics side, software side, and then kind of fell into hey, this fund model makes a lot of sense. Let's do it. Not, hey, let's go do this fund and then have to put all those pieces together. I think if we had done that, right, and say, hey, this is the fund we want to put together, let's do it, probably never would have started, because we would have looked at all of the things that you had to do and go, let's go do something else.
Right.
So it was
there's so much. I sound like a consultant, but there's so much synergy between pieces. And I hate that word. But it's but I digress. So you alluded to this, and I think it's a great place for us to sort of round the turn. It is Kentucky Derby weekend, right? So we've got a big race this weekend. So we're rounding the turn here, and Kiah, I want to ask you about organizational like lessons. The team you've alluded to having invested in this infrastructure. It's clearly not just the two of you. So give us a perch of from that perch of like, as two leaders, co-founders, like help us understand what are the different pieces you've had to put in place and have put in place in terms of the organization itself?
Yeah. So one quick note, right, from a level of, the professionalism, right? People can go out and build software. The asset management platform that we built, one of our clients is a publicly traded bank, and they use their custodial services for the tax lien industry through this. And so the level at which this software was built to meets publicly traded bank requirements within that. And so it's not just a piece of software that we clip together. At this point, it's over a decade of development that's gone into it, and it is a robust piece. To the back to your question and what the team looks like, I'll let Brian give you the latest head count because we keep incrementally growing. But within that, right, it has a segmented parts, right? We have our data team, we have our software team, we have our customer service team, we have our asset management team for the fund side, and then we have our boots on the ground team. That's our internal staff that are flying places, looking at assets, managing assets. And then there's the outside layer of the profit share partners that we work with. And within that, and the synergies, as you so alluded to, that come of this, right, it allows it to work really well. And to Brian's point, you probably are, it's not that people can't go out and build this, but it is a Herculean lift. And somebody's going to question whether or not it's worth it. There was a lot of people who've come and gone in the asset management software space. You watch them come in, and as a founder of a software company, you get a little nervous, and then you watch them kind of 2 years later, they exit out because the complexity that goes into this is no small task. And so, lessons learned, maybe I wouldn't go build a tax lien asset management platform and all of the things that go around it due to the complexity. But, you start out on a journey and you learn something along the way. And now we have a highly valuable tool that we can run the fund off of and grow from there.
Yeah. Well, so Brian, you started out, I guess, and we're working with Kai's company, going all the way back to the very beginning of our conversation. So I'm going to give you the last word. When you set out to tackle this, and you look now, a decade plus, you've learned a lot, you've added a lot, your now ambition is grown. There's a big opportunity out there. How do you stay, laser focused on the right things, right? How do you stay super focused on creating value for customers? Because that's ultimately why they come back, is you're creating value for customers, whether those customers are on your data side, whether those are now investors in your business on the Mountain North Capital side. Like, if you don't deliver, they're not going to stick with you for long. So as the sort of original, owner, founder comes into play here, I always like to ask, like, what are the things you have to continue to remind yourself of every day to ensure you're delivering value to your customers?
Yeah, the adage, stay in your lane. I've had to kind of, I view it from a double-edged sword or double-edged coin, right? There on one side, right, is like, the thing that we got to stay true to is doing something of quality, right? And that was our differentiator from the very beginning, is doing something of quality for the institutional level investor, right? And working with Kiah on the software side. And that continues to be our mantra, because it, on the flip side of that is like, stay in your lane, right? There's some levels of stay in your lane where just kind of ends up being idiotic. For example, like a lot of the areas we're going to for auctions initially on the tax sale side, our bidders were, for example, in Texas, they call it Super Tuesday. All the auctions happen on the first Tuesday every month. And there's a big giant room, and on half of the room, right, is a tax sale going on. The other half of the room is all of these foreclosure, opportunities going on, mortgage foreclosure sales, right? And our bidders are attending the tax sale, and they're buying a few properties, and they're seeing like the volume of the properties on the other side of the room and just the incredible activity. And they're kind of like, hey, we should look at this. We should look. And for many, many months, we were like, no, that's not, we need to stay where we're at. But eventually they convinced us to go look at the data. And sure enough, it's like, wow, we can get, because the assumption was we can't get nearly the same discount because of, that's, everybody knows of mortgage foreclosures, well, what we didn't really take into account is the convoluted process that was being utilized in selling the properties. And so when we looked at the data, we're like, wow, you can get the deals over there too. And the volume of potential assets that we could buy exploded, right? And then we went to like, okay, from the data side, we need it internally, from a product standpoint, is this something that we can make into a product as well? And again, learn, like, all right, from a quality standpoint, it didn't exist. There were a lot of platforms out there providing foreclosure data, but they were doing what I call the easy stuff, right? An example would be at an auction, there's an online trustee selling 170 of the properties, but there's 20 other trustees selling the other 200 properties, and nobody was providing all 370 properties. And when you start going to the sales, we realize, wow, there's an opportunity not only from from the fund perspective, but also doing what we have done on the tax sale, which is provide something of quality that encompasses everything. And that's really where we've tried to balance the two. Of we're opportunistic. We can't keep our eyes closed and say we can't do that because, right? We got to understand what that because is, and if there's a way of opening that door, why not open the door if the opportunity is there and it makes sense for what we're doing without getting way off track, right? Are we going to go buy property in Italy? No.
Yeah.
It's way outside the bounds, right? But are we going to open up other states or other types of acquisition methods of getting into those opportunities as we learn about them and can vet them? We're open to that.
Yeah, as I always say to my young boys, just because you can doesn't mean you should. So look, and I remember when we very first met, and I said to myself, having worked in this space with a fund, a hedge fund that was doing some distressed and opportunistic investing after the GFC or at these auctions, and I said to myself, if I'm an investor and I'm an advisor, which I am now, why would I want to try to go do that myself when I could just find a great partner to do it who's got a better competitive advantage and a better moat and better all the way around, right? And that's the beauty of being able to have these conversations for me at ATLalts and with our firm, is that we are like heads down every day trying to find groups that are doing something within one of those big verticals, real estate, what have you, credit, but doing it in a way where they've got an unfair advantage over everybody else. And so this conversation to me has really illuminated a lot of different things that you've layered into your platform. So I really appreciate it. I want to ask you, Kai, how do people learn more? How do people understand how they can get engaged further with all the different things you guys are doing?
Yeah. So you can reach out at Kiah, Kiah, at taxsaleresources.com. And from there, we can get you a link to our investor portal that has our PPM and all the investment docs that go along with that. And happy to set up a call as well. There's a schedule call link in there, and we can talk about the opportunity at hand. Right? There's always questions that come up with these things, especially when you get into the alt space. So we can drill down into those and talk about some of the specific assets. And yeah, happy to share the model with that, and let people know anything else that they want. The other highlight that's around who Brian and I are is we both bootstrap both of our companies. We didn't take outside funding. These companies weren't built off of investor dollars, and we stayed in a bootstrap lane and grew for an industry. And this was the natural, organic next step for where we're at today.
Yeah, fantastic. Well, Brian, Kai, I really appreciate you, sharing an hour plus with us here today on ATLalts. I will absolutely make the show available to listeners on both ATLalts and our asset-backed platform, because I think there's so many aspects of the conversation which are very relevant. The show notes and how people can get in touch with you and how they can learn more. So with that, we'll wrap it up. I appreciate your gentlemen, both your time, and continue to wish you guys the best of luck with what you're doing at both Tax Sale Resources and Mountain North Capital.
Well, thank you.
Thank you. Thank you, Andres.
Thanks, guys.